Hello and welcome to HHM's Nonprofit Financial Oversight Panel. I'm Adam Osborne, a partner of HHM CPAs and one of the key leaders in our not-for-profit niche. On an annual basis, I have the opportunity to work with an array of not-for-profit organizations. Not only do I get to work with them, but I also have the opportunity to serve in some communities on board of directors with organizations that I'm most passionate about. What makes today's webinar special is the fact that it's not only geared for not-for-profit organizations, but it's also geared for those individuals that serve on boards of directors. As you listen to this webinar, I will challenge you to identify individuals who could benefit from hearing these questions and answers. Pass this video along and spread the wealth of knowledge that we're providing today. Today, I'm being joined by a couple professionals in this industry, and I consider them industry experts. We're going to answer some commonly asked questions regarding boards of directors and financial committees and just overall management in a question and answer style format. So today on site, in the studio here with me is Randy Dummer. Randy is a partner with HHM CPAs. And Randy, why don't you introduce yourself?
Sure, thank you, Adam. So I've been with the firm for 10 years now and been in public accounting for 34, which is a bigger number than I'd like to admit sometimes. And basically started out the first audit I ever worked on with the not-for-profit audit. So been doing this for 34 years. And you know, when Adam and I and our not-for-profit group here talked about doing this type of format, you know, we also then reached out. One of my peer review clients is a firm that specializes in basically only doing work with not-for-profits. So we have Mike Batts from that firm joining us today. So Mike, could you introduce yourself to our audience, please?
Sure, thank you, Randy, and hello, Adam. Great to be with both of you today. I'm Mike Batts, managing partner of Batts, Morrison, Wales, and Lee. As you just mentioned, Randy, our firm exclusively serves nonprofit organizations from our two offices in Orlando and Dallas.
Thank you, Mike. Thank you so much. So today, as I mentioned in the opener, this is a question and answer format. And as you develop questions throughout this webinar, feel free to put those in the chat and we'll respond accordingly. So I'd like to kick us off, Mike, with you. And the first question is, as a board member, what is my role with respect to overseeing the financial aspects of the organization?
Yeah, well, you know, with respect to the role of the board as a whole and the board members individually, it's easy to miss the fact that the board itself and the board members individually making up the board collectively actually have the ultimate responsibility for the affairs of the nonprofit organization with respect to everything, not just financial matters, but everything. I mean, the buck ultimately stops with the board, the governing body of the organization, as a matter of law. So the board is really the gatekeeper for all things the organization does. And in the nonprofit sector, sometimes boards don't fully realize that that's their role or that they have that legal fiduciary duty. You know, I've heard board members say things like, well, you know, our board is really a fundraising board, or our board is more of an advisory board to the CEO. Well, that may be the way they operate, but you know, the reality is that they have an ultimate legal responsibility for everything. And I mentioned that word fiduciary duty, which is a $4 word, but it really does have a specific technical meaning. Under the law, board members have a fiduciary duty, which is broken out into three components: the duty of care, the duty of loyalty, and the duty of obedience. And so the duty of care is just to do things responsibly, like a reasonable, prudent person would. The duty of loyalty is to be, you know, true to the organization and to subordinate your own personal interests to those of the organization. In other words, whatever you do in your role as a board member, it needs to be in the best interests of the organization and not yourself or your company, of course, or anything like that. And then the duty of obedience is the duty to abide by the laws, the regulations, and your own organization's governing documents and policies as you carry out that role. Now the financial aspect of a nonprofit is just one component, obviously, of a nonprofit's operations. It's a big one, and it transcends a lot of other things. But really, the role of the board is all the above.
Yeah, I agree with that completely. And to take it a step further too, to really answer the question, what is your role in the board, can depend a lot on who you are as a person and your profession, as well as the size and complexity of the organization and the board. In addition to auditing several not-for-profits, I've been on boards, and of course, as a CPA who's a not-for-profit auditor, you're expected to be very familiar with the financial aspects of the organization. Even in the rare instance where I was not the treasurer on the board, I was actually a vice president instead of the treasurer, the rest of the board would still look to me when it came time to ask questions about the audit or anything from the financial, the treasurer gave the treasurer's report, and if they had questions, more often than not, they went to me. So, you sometimes you just can't get away from it. But being a CPA, I think I have probably an assumed higher responsibility related to the financial aspects of the organization than, for example, the board president who runs a successful retail business, for example.
Thank you, Randy. Thank you, Mike. That leads me into question number 2, and it's a question that we ask a lot whenever we're serving on boards. And how can I determine if the organization I'm serving is financially healthy or responsible? Randy, why don't you start us off?
Yeah, there's a lot of different things that you're going to look at, and again, most of these things are going to depend on the size and complexity of the business, but the organization. But most of the time, what you're looking at is your cash. So what is our cash in? What is our cash out? And how much control do we have on the cash that's going out the door? So if we've got rent and salaries and things like that, many of those can't really be changed a whole lot in a short period of time. And there's a lot of other factors that are going to, influence that as well. What are your revenue sources? Are you tied into a few different sources? Do you have government grants that are pretty well established where you're going to be getting similar amounts each year that fund a significant portion of your normal budget? How much of are you reliant on those fundraising activities? You think about some of the organization we have here in Chattanooga where there's this big to-do, this big annual event that provides a significant amount of their funding. That's great till COVID hits, and you can't hold the event. So there's a lot of different factors. I think most board members really focus on the cash, and I know there's a lot of other aspects to that. So, Mike, why don't you share some of the other things that you've run across in your experience as well?
Yeah, I certainly think cash is key, and that's a critically important part of liquidity. And whenever we look at a nonprofit and we make that assessment, when we're asked about possibly serving one, we'll look at the organization to make our own assessment about whether it appears to be financially healthy. And generally speaking, we'll look at the balance sheet. We'll look at the liquidity level of the organization, focusing on cash, investments, looking, the overall liquidity of the organization, and then we'll look at the liabilities and see if it appears that, they have significant liquid assets in excess of their liabilities or not. We actually have developed 6 metrics for financial health that work for almost every kind of nonprofit. We've been testing and trying these metrics over the last several years, and they seem to work well. Starting out, Randy, with what you suggested, we look at operating cash reserves, and we have a metric level that we call sound, and then one that we call strong. And operating cash reserves of about 3 months worth of operations we would consider to be sound. And then 6 months or more of operations, we would consider to be a quite strong nonprofit. If a nonprofit has debt, mortgage debt or other kinds of long-term debt, then we would look at their ability to service that debt and debt service reserves. We tend to look for, a sound level of debt service reserves at about 6 months worth of debt service, meaning principal and interest. And then a strong level we would consider to be a year's worth. And the idea there is that if a nonprofit has some unexpected downturn in revenue sources, just like you mentioned, Randy, you want to be able to have time to adapt to that new reality while you reorganize things. And a debt service reserve allows you to keep paying the bank while you figure things out. There are other things like how much debt do you have? What is the loan to value ratio of your mortgaged assets to your debt? Sometimes in bad economies, those loan to value ratios start to get high, and that can be concerning. We look at your debt service as a percentage of your operating budget to see if it looks too high. Generally, we like to see no more than about 15 to 20% there as a sound level, and less than 10% would really be a good, healthy, strong level of debt service. And then finally, we look at the average age of accounts payable invoices, because if you've ever paid attention to the business world at all, you know what happens. The first thing that happens when cash flow starts to tighten up, you slow down paying the bills. So looking at the average age of accounts payable can be an early clue that there might be, some things there to pay attention to.
Yeah, that's a lot of good stuff there. And one other one that I've actually run across in a couple of the organizations I've worked with is it wasn't so much the debt on the buildings or secured debt. It was line of credit, and they were needing to tap into the line of credit to fund their ordinary operating expenses, and that's a recipe for disaster right there. Sometimes there's some short-term needs that you can meet until things turn around. Sometimes you start looking at, gee, how can we get cash in to pay back that line back down? But if it starts needing to be drawn up again, that gets to be a problem too.
And I think it's important to think about that as well, given the fact that there's now liquidity footnotes on our financial statements. So if one of our organizations is being audited, that liquidity information is right there in the financial statements now and open to those who get the financials.
Exactly.
Yeah, whenever we define operating cash reserves, we take cash and other liquid assets. I mean, like if you've got investments, investment portfolio, we consider that to be the cash piece. But then we'll back out current liabilities. So, your payables, your accruals, your line of credit, because that's really what gives you an idea of what your reserves are. Obviously, you can't borrow your way into having cash reserves, to your point.
Right.
Exactly. So now, obviously, I've talked about some of my experience. Mike obviously has a lot too. Adam, I know you've served with some boards as well. So what sort of information did you like to see on a regular basis from the organizations you worked with to kind of help you make some of these analyses to see what kind of position they were in?
That's a great question, Randy. And honestly, you mentioned and alluded to this earlier, that for every board member that looks different. And I think that I think it's imperative that we take the information from the software and we produce useful information to the users of the financial statements. What I could use might look different than what somebody else uses because they have no financial background. And so to me, I believe it's imperative that you're transparent and that you present the information in a way that's not misleading to allow someone to come to a different judgment than what really should be about how the organization is performing. It should be useful, it should be informational, and it should be transparent. Those are kind of the things that I think about. Mike, what about you?
Yeah, I wrote an article a little while back entitled, "Is Your Financial Reporting Process Exactly Backward?" And over the years, I've seen this happen so many times where, a nonprofit organization's accountants and financial people, all of course very well intentioned, basically produce whatever financial reports and accounting reports, their software is, designed to produce, and the board or the finance committee gets those reports, and a lot of times it's pages with numbers spread all over them. And they hand them out in a meeting, and everybody looks at each other and looks at them and nods their head and acts like those numbers all make sense to them. And just like you just said, Adam, the reality is that if you're not a financial person, a page with numbers all over it is probably not going to really make a lot of sense to you. And it's certainly not going to be the kind of information you need in order to make good decisions, strategic decisions as a board member. So, that's what I call exactly backward. So the way we look at it is the board or the finance committee or the CFO, whoever it is that's in a decision-making role, needs to provide clarity with respect to the kind of information they need, and the information they get should be provided to them in a format that they understand. Of course, yes, you're right. It should be timely. It should be relevant. It should be accurate. But just as importantly, it should be in a format that the user can understand. And we're talking here about internal financial reporting, right? Not external financial reporting. So the audited financial statements that both of you gentlemen work on regularly with your clients, those have a prescribed format under generally accepted accounting principles. And that's not what we're talking about here. There are no laws or rules that govern internal financial reporting. It can be in any format that helps the decision makers make good decisions. So, we actually have recommended that you use different methods that work for different groups. That can include narrative descriptions, that can include graphic illustrations. And we actually created a list of 27 questions, and we said, if your board or your finance committee doesn't know the answer to these questions as a part of your regular reporting process, then you probably have some work to do. This will only take a minute. I'm going to fly through 11 of those questions here just to give you an idea. And I would encourage those who are viewing this webinar to think about whether your financial reporting process gives you the answers to these kinds of questions. And this is only 11 of our suggested 27. But is the organization's current liquidity sound or strong, and how do we know? Is the trending in the liquidity improving or declining? What's the organization's current balance for cash and other liquid assets, and what is that balance net of donor restricted amounts? If your current accounts payable and other similar liabilities were paid off, how many months worth of cash operating reserves would we have? And how does that compare? How does the answer to that question compare to our target? Do we have a target? Is there a plan in place to improve our operating cash balance? What is the plan? Are we paying all of our bills on time? How do we know that we're paying all of our bills on time? Have we had any trouble in recent weeks or months paying our bills or meeting our cash flow demands? Do we expect to have any trouble in the near future, in the foreseeable future, meeting our cash flow demands? Have we borrowed any money to pay our regular bills, our regular operating costs, or any of our non-capital outlays? Have we dipped into donor restricted or designated balances of cash in order to fund operations at any time? What's the current balance of our mortgage debt, and are we paying those debt payments in a timely manner without any stress? That's 11 questions, and I would venture to say, because I've asked these questions of people that serve on boards and finance committees, I asked them, do the regular reports that you get as a part of your regular process, do they give you the answers to those questions? I have yet to have someone in those roles tell me, yes, they do. So I think that begs for, a clearer, more plain English, if you will, format for reporting internally to those who make decisions. I mean, the reality is you need answers to those kinds of questions in order to know how your organization's doing and in order to make good strategic decisions.
Exactly. Now, Like I said, I've been treasurer of a couple of organizations, and I understand my audience with the rest of the board is not the same audience for the year-end financial statement. And one of the things that I typically tried to convey in my regular reporting was what is our actual and what is our budgeted amount, and how much then, what's the annual budget and how much is still left in that regard. And certainly there are things that were seasonal, that we'd have these expenses in one particular time of year and they'd go away. But it was all cash basis, not dealing with accruals, and because the rest of the board members didn't want to deal with accruals. But it was all cash basis. Where are we at compared to budget? And that was a one-page report that was sufficient enough detail that if you wanted to dig into it a little bit, you could, with nice summary subtotals, so those who just kind of their eyes gloss over when they see a page full of numbers can look at the few highlighted numbers and say, okay, yeah, we're behind on donations this year. Darn it, we're ahead on expenses. How are we going to get that to come together so that we have a decent year here before we're all done? So that's one of the things that I have found being helpful. And depending on the organization, again, you may need to almost kind of go a rolling 12 months out sometimes in terms of where you expect things to be, especially if there are cash flow issues and you're not in that strong position that we've referred to today.
All good points, and Mike, you made a great statement just a second ago when you went through those 11 questions. I bet just the same as you, not many people can answer most of those questions, and so my hope is that this webinar kind of opens our eyes to how we should really be serving on the board. That leads me to my next question, and Randy, you talked about this just a second ago. We just came out of a season dealing with COVID, and funding sources have changed. What concerns should I have as a board member if I have very few funding sources? How should we address that?
There can be significant concerns related to that, or there can be minor concerns related to that. And I said earlier, organizations with a government grant. Okay, so if your main funding, 80% of your funding, is through a government grant that is pretty typically renewed on an annual basis, you've got some stability there. Now, I happen to serve on a board at one point where that was our deal. Okay, 80% of the budget funded through a grant. Then there was some discussions, don't even remember who was president at the time in their administration, about significant curtailing of funding in that particular area. So, as you got to a lot of organizations around town, as things got tighter, started looking at, we're only going to deal with basic needs. Okay. Our organization happened to be one who provided volunteers and help for a whole bunch of organizations. So we weren't seen as a basic need. And all of a sudden, we were wondering where our funding might come from should that government grant go away, because we weren't necessarily going to be on the top of anyone's list, even though we filled a really good and important role in the area. It's like, yeah, we want to support the food bank. Great. We supply people to the food bank, and we need money to do that. Or so if we can't do our thing, they can't do theirs. But if it's an event, if it's a particular donor, there's a significant amount of risk there if you just have a few donors, or just a certain group of donors that you're relying on for your funding. And one of those examples I had, the main organization was basically started when a guy retired from this large organization. They said, we want to make a donation in your name. What do you want to do? He says, well, let's start this. And they gave $1 million, and they were given a couple $100,000 a year. And it wasn't a basic needs organization. And that organization at some point, 15 years down the road, said, we're only going to give our money to basic needs organizations now. Boom, we lost 70% of our funding. So how do you recover from that? And part of that is always looking as you're running the organization to diversify where your revenue is coming from. Are you United Way funded? If not, can you get on that list? Are there other things that you can do? Maybe joint participation with other organizations that have similar missions to you that can help out, and even some cost sharing type arrangements as well. So there's a lot of different opportunities there, but you have to constantly be proactively thinking about, gee, we have this risk because of this concentration. And the audit financial statement is going to tell you there's this risk, right? So, but what do you do about that risk, and how do you manage that from a board standpoint?
And you make a good point, Randy. Concentrations are disclosed if you're having an audit, but those concentrations can really prohibit your ability to continue as an organization. So Mike, what thoughts do you have on that question?
I think you guys nailed it. I don't really have anything to add to that. I think, concentrations are certainly a risk factor that everybody should be aware of. And you guys covered that question great.
So Mike, that takes us to the next one. Why is the board's annual reading of the Form 990 an important process?
Well, I think tax compliance by nonprofits itself is a very important part of managing the risks and the financial compliance of a nonprofit. And the 990, of course, is a component of that. There are what I call the big four of tax compliance issues for nonprofits that if I'm on the board of a nonprofit, and like you all, I've served on the boards of nonprofits, I've chaired the board of nonprofits, and if there were issues that I would want to make sure I paid attention to in the tax compliance arena as a board, it would be what I call the big four. And the first one would be executive compensation setting practices. Because the IRS, there are rules, regarding reasonable compensation for nonprofit leaders. There are also guidelines for how to set compensation to create a buffer of protection for those who are in leadership. Related party transactions between the nonprofit and its board members or its officers is another area that is sensitive and subject to compliance risks for similar reasons. Payroll tax withholding and remittance, as you both well know, anytime an organization starts to play games with paying in its payroll tax deposits on time after it's withheld money from employees' pay, really bad things can happen really fast. And so you never want to be on the wrong side of that issue. And then the Form 990, itself, which is a compliance aspect for nonprofits. So, I think when a board reads the 990 as it should, and that's one of the questions on the 990 is, did the board read it before it got filed? And they ask those questions for a reason. If I were going to really focus on some issues in the 990, I'd focus on those things. How do we answer the questions about how executive compensation is set? How do we answer the questions about related party transactions? And the rest of the 990 is informative and interesting. I would say that outside of the 990, I would also want an independent channel of information coming to the board to assure us that the organization stays in compliance with its payroll tax deposit requirements because of the obviously significant implications of violations there.
And I think it's healthy to know from a not-for-profit organization standpoint that 990 is a public document. It
Right.
eventually makes its way to guidestar.org, where anybody who has a membership there can download it and look at it. I believe it's important to look at the allocation of the expenditures between program management in general and fundraising activities. But similar to what Mike said, I think most board members are kind of clueless when it comes to the 990. They do not understand how to read it. They do not know how to interpret it. And oftentimes they ignore it. And so I think that offers a great deal of concern. Randy, what's your experience on the 990?
So obviously I've been treasurer on a few boards, and we send the 990 out to the rest of the board. And the one time I actually presented it at a meeting and said, gave it to them at the beginning. I said, we're going to vote on this at the end, but you've got this if you want to glance through it. And there was a realtor on the board who kind of raised his hand and says, I'm not reading these 30 pages. What should I look at
Right.
in my 5-minute approach to
Right.
that? And you know, to Mike's point, executive compensation, I just tell them, you know, look at the schedule out. Does it describe what the organization does as you understand it? Because he wasn't going to look at the financial information. Our finance committee had done that and poured through that. You know, I think I'm a nice guy, but our auditors didn't like when they had to deal with me on the finance committee, I'll tell you that. I questioned every little checkbox on that 990 and every little disclosure on the financial statement. But, you know, so we had gone through that. So, you know, from that typical board member standpoint, you know, they're just going to say, I'm not looking at this, that's too long of a form.
Right.
So
Right.
you give them a few highlights, things to look at so that they understand, yeah, that's the information that I can understand, and I need to make sure that it's right based on how I know this organization.
Yeah, the good news is that a board or finance committee, if it has one, or an audit committee or its equivalent, you know, one of the great things about working with a firm like yours with nonprofit expertise is that you all have that knowledge and familiarity with the tax compliance issues for nonprofits. And part of that audit relationship is, you know, bringing that awareness to the audit client. So, you know, you can help them reduce that risk as part of the overall service model.
Exactly. So you led us into risks, and that's where we wanted to go to next, managing risk and what do board members need to be most concerned about.
Okay, that leads us into an important topic in managing risk. What are some of the key risk areas board members should be most concerned with? Mike, why don't you start us off?
Well, yeah, I mean, as we mentioned at the beginning of our time together, you know, board members have that ultimate, you know, fiduciary duty to oversee the affairs of the organization. And that really means risk management is a part of the board's role, a significant part of the board's role. That said, one of the things I would like to mention here is the proper role of the board versus management. You know, the board's role in one of the books that I've written, I describe the board's role as SOP, strategy, oversight, and policy. And in a well-governed organization, meaning one that is not dysfunctional, the board tries to stay in that lane of strategy, oversight, and policy, and they let management, you know, run the organization and make the day-to-day operational decisions. So, you know, when it comes to risk management, the board's role is one of oversight. And sometimes we see in organizations that may not be well governed and they may not, you know, have the board and management in really the right lanes, we'll see boards or board members start to engage in issues that are really operational issues. So if I could maybe say first, I think the board's role in the oversight capacity is to ensure that management has a good handle on risk assessment overall and a good plan for managing and mitigating risk overall. And the board should understand what that plan is, and the board should speak into that plan. But it's not the board's job to make sure that the vehicles used by the organization are inspected for safety. It's not the board's job to, you know, deal with the operational decisions. So, you know, starting with that, I think because sometimes boards cross those lines and that creates some real issues. But, you know, just in terms of areas of risk that the board should be paying attention to and should be speaking into and making sure management has the bases covered, you know, that would be things like general compliance with the law in areas like human resources, you know, labor law, wage law, healthcare law, employee benefits law, healthcare privacy laws, copyright law, laws governing donor restricted funds, laws governing investment practices by nonprofits. By the way, every state in America except Pennsylvania has adopted a model law called the Uniform Prudent Management of Institutional Funds Act, which governs how nonprofits are supposed to manage their investments. And so we need to be watching that kind of thing. laws governing charitable solicitation registrations and fundraising activities, laws related to reporting actual or suspected child abuse, zoning and land use, and others that might be, identified by the legal counsel for the organization. Let me just mention that some specific areas, other than just compliance with the law, which is kind of the list I just talked through, there are some specific operational areas of risk that are a really big deal, and boards, should, again, in that oversight role, help make sure that management has these bases covered. I would start with the risk of child molestation. For any nonprofit that works with kids, that's sadly an increasingly pervasive problem. You've seen that, you've read about it. It's a significant issue. Data security is obviously front and center for any organization. Insurance coverages, physical safety, things like the facilities, are they safe? Workplace violence, the risk of those kinds of things. And then other things that are maybe not as obvious, like leadership, succession, and public relations. But, I think big picture, the board's role is to, remember that they have that responsibility for overseeing. That includes risk management. Make sure that these big bases are covered. Make sure that management has a plan to do that and speak into it as needed, so that everybody reaches a level of comfort, that they believe is appropriate for their organization.
And Mike, you mentioned briefly there about cyber data security, and I might recommend for our not-for-profit clients to invest in a cybersecurity policy. And that's one that's become a big popular item, just with all the breaches that are occurring. Just this past year, I had an experience where some data got ransomed. And that cybersecurity policy stepped up and really covered that data breach. So that's an important item to note. Also, a directors and officers insurance policy. A lot of organizations I've worked with do not realize the importance of that policy. And it covers the directors and the officers who are making the key decisions for the organization. Randy, other thoughts?
Yeah, one other thing I want to add there, and Mike talked about, board needs to stay in their lane. Well, sometimes the lane gets to be blurry. And I've had experiences where, we've been talking about financial situations and, reporting on budget, and, so you're going over budget with the expenses. And the board tries to give direction to management. Hey, you have to keep these expenses under control. We're 30% high on wages. We need to cut back on wages. And management's saying, I can't cut back on wages. I can't get stuff done. Man, that gets to be an issue. And Mike, I'm just looking for your feedback on what you've seen there and how that can try to resolve itself peacefully, if you will.
Well, I speak to that to some extent in a couple of the books that I've written. You're right. I mean, the board has that responsibility for the fiscal or financial management of the organization, its financial health. And so budgeting is clearly, a central part of that. And the board has to set those parameters. The board sets the parameters for strategy, oversight, and policy. And hopefully they can do that in a together collaboratively, in terms of discussing those questions with management. But at the end of the day, if management isn't able to operate in a manner that conforms with the board's parameters, then the answer to that question is not for the board to all of a sudden start meddling in operations. The sad reality is that the board has an HR issue with management.
Yeah, exactly. That's a good point. I've had that in more than one organization where, things are tight fiscally, budget's got to be monitored closely, and it gets to be a fairly testy situation.
And another risk I think about is the risk of involving fundraising. I've seen it a lot where it's like a bait and switch tactic, and you have to be mindful when you're fundraising that you are actually spending those funds in the manner in which you're fundraising. So I think that's another key risk that we as board members can keep in mind.
Yep. So, you talk about fundraising, leads us kind of right into the next thing we wanted to talk about is what we all hate when we're on the board is donations that are with restrictions from the donor. So you can only use for a specific purpose. And those get to be a challenge more from an accounting standpoint a lot of times than anything else. And I'll kick this to you in a second, but I'll just share that I took over as treasurer of an organization in a previous life in a previous state, and we had so much restricted funds on hand and poor records. And we start trying to go back through them, and it turns out it's like, a lot of these restrictions were for this purpose, and we spent the funds for that purpose. It was just a bad accounting thing. Once we actually went and got through and spent way too much time than we should have to clean that up, we were in a little bit better financial position than we wanted. So, Adam, what have you seen in regards to that?
Well, I think you make a great point, Randy, and that's executive directors and controllers at not-for-profits oftentimes don't know. I know I was at a board meeting recently, and we got some funding in, and it was clearly restricted. And I mentioned to the executive director, make sure that this gets into restrictions because we're not going to spend it before year end. And I got that glazed look of, I have no clue what you're talking about. And so it's an education for the boards we're serving on. It's an education for the clients. It's a bigger education for the board members, because they say what is with restriction and what's without restrictions, because those are some new updated terminologies for the industry. So Mike, give us some insight on how you explain this to board members, how you advise them and guide them.
Yeah. Well, when a donor makes a gift and the organization accepts it under an agreement that the gift is going to be used for a specific purpose, whether that's a particular activity or a particular project, whatever it is, if those are the terms of understanding between the donor and the organization at the time of the gift, that creates a legal obligation of the organization to honor that restriction with those funds. And so if the board and the organization don't understand anything else, they need to understand that it's not just bad PR, although it is really bad PR to use donor restricted money for something other than the purpose for which it was restricted. It's also likely a violation of the law and can be criminal. And so, you've got to have the right kind of accounting systems. You've got to have people, that are adequately knowledgeable about how to account for things separately, to do nonprofit accounting properly, so that those restricted gifts can be properly tracked, both when they come in and when they get spent. That's just a fundamental element of keeping everybody safe. And as some of our clients like to say, that's one of the ways that we help them stay out of jail.
Yeah. Randy, let's say that I go out and raise money for my not-for-profit, and there's some restrictions that come along with it. And then the organization changes their course of action on how they're going to expend those funds. What recommendations do you have for not-for-profits and how to remedy that situation?
Well, so generally, if you get funds that are restricted for a specific purpose and you then decide that you do not want to spend them for that purpose, they really need to get returned back to that donor, or communication with that donor regarding maybe adjusting that restriction. I'm going to tell a little story here. That I'm a sports geek, right? So I watch a lot of different weird sports. And I was watching, and I'm originally from Wisconsin, so Wisconsin, North Dakota used to be a huge hockey rivalry. And there was a guy for the University of North Dakota wanted to make a big donation to build a new hockey arena for their university. They're the North Dakota Fighting Sioux. He did not want them to ever have to change that name, and obviously there's a lot of pressure to do that. Sure. But he couldn't necessarily control that aspect of it. So the restriction he put on his donation, he gave millions of dollars to help fund this arena under the condition that every seat have a Fighting Sioux logo embossed in the leather in that seat. So they might change the name, but the logo was going to have to be there. And so the university built the arena and they had the logo in every seat.
It's an amazing story.
Yeah.
Mike, do you have different thoughts on that as far as?
No, I agree with the thought. You know, when you find that it's no longer feasible to follow a donor restriction, you know, that you thought you were going to be able to follow at the time you received the gift, that's a checkpoint. And it's quite likely that refunding or offering, you know, for the donor to grant you permission to redirect the funds would be the right way to go. One of the challenges you run into, practically speaking, and I've just talked with an organization a few days ago about this exact scenario, is maybe it's a building project. You raised a bunch of money for the building project. You spent some of the money on the building project, on architects and design and site planning and whatever, and then you abandon the project. So it's not like you have all the money still there. So basically, honestly, what we recommend is, refunding contributions is not a light matter. And we just recommend that organizations consult their legal counsel whenever they're in that situation and follow the advice of counsel on how to navigate that. And it is often some kind of a combination of refunds or permission to redirect the funds, but it's ultimately a legal matter, and we think it's good to have it navigated by counsel.
Great, thank you, Mike.
Now, one other thing related to that, I mean, I think we're all kind of assuming these are cash donations, but what about if we have non-cash donations?
Right.
If we have property or even stocks, the organization really needs to have a policy in place with how they deal with non-financial, non-cash donations. Generally, what I see is if it's stocks, they're not going to hold them for investment; they're going to sell them. So that they're pretty close to the value of when they receive that donation. Pieces of equipment, I've seen some, like labor union trades where they use them for their apprenticeship programs. Okay, well, you get that old piece of equipment that company had and gives it to you. Okay, well, you're going to use that in your training program, so that's fairly simple, but you need to understand there's a lot of differences and nuances to what happens if someone wants to give us something other than cash. What about Bitcoin? What if they're going to donate Bitcoin? Are we even prepared to handle that? Do we even know how to get rid of it? So these are things that boards need to continually think about, not just restrictions, but form of that contribution.
All great points. And that wraps up our panel today. I'd like to thank Randy and Mike for joining us and being so candid in their responses. As I mentioned earlier, this webinar is for all individuals that could benefit from it. Feel free to share this video with others. Should you have any questions that arise from this video, feel free to reach out to HHM CPAs.